Workers are quitting their jobs in droves. And believe it or not, that's usually a sign of something big. Here's the counterintuitive part. When people walk away from steady paychecks, it can tell us more about the economy than the unemployment rate ever could. Sounds backward, right? But stick with me. The government tracks this through something called the quit rate, basically a confidence meter for workers. When quits are high, it often means workers believe they can do better. More pay, better hours, better fit. When quits fall, people are hunkering down, choosing stability over risk. That simple choice, where stay or move, is a surprisingly powerful signal. In this video, we're going to unpack what the quit rate actually measures, where it stands right now, why economists obsess over it, how it links to wages, how it shows up differently across industries, and ultimately what it means for you, your paycheck, and even the price of your next coffee. What is the quit rate? Every month, the U.S. releases the Job Openings and Labor Turnover Survey. Most folks call it JOLTS. One of the headline numbers inside is the quit rate. It counts voluntary separations, people who choose to leave, not layoffs, not retirements, just I'm out. Think of it this way. If unemployment tells you who doesn't have a job right now, the quit rate tells you who feels free enough to walk away from the one they've got. It's a measure of worker confidence, and that's why it matters. In a shaky market, quitting is scary. In a strong market, quitting can be a ladder. You've probably seen this in your own life. Say you're earning $12 an hour at a coffee shop. A cafe across the street offers $15 plus tips and a predictable schedule. If you're confident they'll take you, you quit. That one decision seems small, but multiplied across millions of workers in restaurants, warehouses, hospitals, and offices, you get the quit rate. It's the story of how optimistic people are about their options. During the Great Recession in 2008 to 2009, quit rates plunged because jobs were hard to find and people clung to what they had. Fast forward to the post-pandemic Great Resignation in 2021 to 2022. Quit rates hit record highs as workers chased higher pay, flexibility, and better conditions. The quit rate moves with the job market's temperature, where the numbers sit now. Let's anchor ourselves. Recently, the overall national quit rate has been hovering around 2.0%, which translates to roughly 3.2 million people voluntarily leaving their jobs in a single month. That's well below the 3% peaks during the Great Resignation, but it's not a freeze-up either. It's more like a steady simmer. People are still moving, just more selectively. Zoom into industries and the story shifts. Hospitality and leisure tends to live near the top of quit rates. Long hours, lower pay, intense pace. People hop for small improvements. Retail trade also runs hot. Cashiers, stockers, and sales associates switch for $1 more an hour or steadier schedules. Transportation and warehousing land somewhere in the middle. When a big player bumps pay, nearby warehouses see departures almost immediately. Construction can swing depending on contracts and seasonality. Lately, quits cooled as workers waited for clearer opportunities. Finance, information, and mining generally sit lower and more stable. So big picture, today's quit rate looks moderate, not as frothy as 2021, not as fearful as 2008. It signals a job market that's cooled from feverish to warm, where people still make moves but want something concrete lined up. Why quits matter? Here's the core reason economists track quits so closely. Quits move early. They're a leading indicator. Quits often rise before wages show up in the data. Most people don't get their largest raises by staying. They get them by jumping. When quits start to climb, it usually means wage pressure is coming. Workers see better offers, take the leap, and then employers left behind have to react. Either raise pay to keep the rest or keep rehiring and retraining. Quits move before the broader economy turns. In downturns, quits sag quickly. People avoid risk. In strong expansions, quits pick up. People take shots. Watch quits carefully, and you'll spot the clouds before the rain or the sunshine before the headlines. Quits drive real costs for businesses. Turnover isn't free. Replacing a frontline worker can cost thousands once you tally posting the job, interviewing, onboarding, training, and lost productivity. If a sector is swimming in quits, Employers feel it in their margins and usually respond with higher pay, better schedules, bonuses, or more flexibility. Not every quit is about the money. In healthcare, burnout is a powerful push. In tech and professional services, flexibility, remote work, hybrid options, sane hours can outweigh a bigger paycheck. The quit rate is the signal. The motivations vary by industry. Quick scene to make it concrete. Company A pays $18 per hour in its warehouse. Company B across town jumps to $20 plus a signing bonus. People at A notice and resignations tick up. A month later, A bumps pay too. The quit rate moved first. The wage data caught up after. Quits and wages. Do people actually earn more when they quit? To check, we look at the Monthly Employment Situation Report, the MSIT, which includes average hourly earnings. Recently, overall wages have been rising at a steady but not explosive pace year over year. But when you overlay wages with industries that have high quit rates, a pattern pops. Hospitality and leisure has seen some of the fastest wage growth. Employers need line cooks, housekeepers, servers, and they're paying more to keep them. Retail has been drifting higher too, not always dramatically, but consistently. Manufacturing and professional services tend to be steadier, closer to the overall average. Here's how it feels on the ground. You're a server making $14 an hour with chaotic split shifts. A new spot offers $16 plus guaranteed no split shifts. Overnight, you have leverage. Either your current manager counters or you walk. Multiply that logic across a city and you see why wages in high-quit sectors move first and move faster. Caveats matter. In healthcare, high quits often reflect burnout. Some nurses jump to travel contracts with big premiums, but hospital systems don't always raise base pay across the board right away. In tech, some quits are about autonomy. Remote work, fewer meetings, no commute, even if the salary's flat. That's why economists read quits plus wages together. One tells you who's restless, the other tells you whether switching is paying off. Industry spotlights, real stories behind the numbers. Hospitality and leisure, high quit, high pressure. Restaurants, hotels, bars, intense pace, variable tips, long shifts. A $1 to $2 hourly bump or a promise of consistent hours is enough to spark movement. Managers scramble to plug holes, so they raise wages, offer retention bonuses, or rotate schedules more fairly. High quits here are like a neon sign flashing pay up. Retail, constant reshuffling. Retail has always had churn, but competition keeps it elevated. A big box store adds $1 an hour and weekends off. Nearby stores lose staff. For workers, the calculus is simple. A slightly better paycheck or a more predictable schedule can be life-changing. For retailers, quits mean hiring never stops. Healthcare, burnout meets demand. Hospitals face a different storm. Staff nurses leave for travel gigs that pay far more, but they're also chasing saner workloads. Wage gains show up in contracts and short-term premiums more than in permanent base pay. For patients, the result can be longer wait times and higher costs as hospitals pay more to fill gaps. Transportation and warehousing, domino dynamics. Logistics is a game of inches. If a large employer raises starting pay, competitors feel it instantly. A small wage change can trigger a wave of exits, which forces the next round of increases. Quits here tell you how tight the local labor market is and how fast companies must react. Tech and professional services, flexibility is currency. Quit rates are generally lower, but the drivers differ. Remote work, flexible hours, or a 4-day week can outweigh pure salary. Some workers swap a little cash for a lot more control over their day. No commute, fewer interruptions, more time with family. In these fields, the quit rate often whispers freedom more than it shouts money. Together, these snapshots show why a single national quit number never tells the whole story. The why is different in each sector: pay, hours, burnout, flexibility. But the result is the same. People leave when they believe they can get something better. Is a high quit rate good or bad? Both. It depends on where you sit. For workers, it's mostly good. High quits signal confidence and choice. Job switchers typically see bigger raises than people who stay put. If you can walk into a better role with better pay or better hours, the labor market is working for you. For employers, it's a challenge. Turnover is costly: job ads, interviews, onboarding, training, and the period where new hires aren't yet up to speed. In service industries, those costs hit fast and hard. To stabilize, businesses often raise wages, improve schedules, or offer benefits they didn't before. For the overall economy, it's mixed. High quits reflect strength. Workers have options. But rising wage bills can bleed into prices. If restaurants pay more to keep staff, menu prices usually drift up. If warehouses pay more, shipping can cost more. None of this is about blame. It's the chain reaction of supply, demand, and human choices. Put it in context: 2008 to 2009, quits collapsed. People clung to jobs. That was a warning of deep economic pain. 2021 to 2022, quits soared above 3%. Workers gained leverage. Wages jumped. But businesses struggled to hire and inflation heated up. Now, quits are steady and moderate. The market isn't overheated and it isn't frozen. Workers still have some power, but it's not a bidding war everywhere. So yes, high quits can be worker empowerment and employer stress at the same time. The trick is balance. Enough quitting to keep opportunity alive, not so much that the engine overheats. What it means for you: this isn't just macro data. It filters down to your day-to-day decisions. If you're a worker, a higher quit rate in your sector means you may have more leverage than you realize. If you've been thinking about asking for a raise, negotiating for better hours, or testing the market, this might be your moment. You don't have to jump blindly, but having one solid offer in your pocket can change the whole conversation with your current manager. If you manage a team or run a business, rising quits are an early warning. If your industry's quit rate is climbing, retention isn't a nice to have, it's your defensive line. Small investments, a predictable schedule, a clear growth path, a modest raise, often beat the cost of replacing experienced people. Culture counts. So do fair workloads. People don't quit bosses until they do. If you're a consumer watching prices, labor is a major cost in services. When industries pay more to keep teams intact, some of that cost shows up in prices. A few more dollars on a meal, a slightly higher delivery fee, a higher bill at the clinic. That doesn't mean workers caused inflation. It means we're seeing how wages, staffing, and prices are connected. Let's bring it home. We started with a simple, slightly provocative idea. When workers quit, it tells us something bigger than just people are leaving. The quit rate is a living pulse, a signal of confidence, leverage, and change. It rises when workers feel they can do better and falls when the ground feels shaky. It pressures companies to adapt, and over time, it shapes paychecks, schedules, and prices. Industry by industry, the stories differ. In hospitality and retail, quits push wages up because people can switch quickly. In healthcare, quits reveal burnout colliding with demand. In transportation, small pay bumps trigger big movements. In tech, freedom and flexibility are often the prize. There isn't a single why, but there is a clear what. When workers believe in better, they move. So is a high quit rate good or bad? It's both. For workers, it can be a ladder. For employers, it's a cost and a challenge. For the economy, it's a balancing act. Too low, and it signals fear. Too high, and it risks overheating. Right now, we're in the middle. Not cold, not boiling, which means decisions still matter. Your decisions still matter. If this breakdown helped you see the job market a little clearer, here's how you can help this channel. Tap like so more people find it. Subscribe for more plain English breakdowns of jobs, money, and the economy, and drop a comment with your story. Did you quit recently? Was it for pay, hours, flexibility, sanity? What happened next? Your experiences aren't just anecdotes, they're the human side of the data we all read. Because at the end of the day, the economy isn't a spreadsheet, it's people. It's the barista who wants one stable weekend off, the nurse who needs a safer workload, the warehouse worker who deserves an extra dollar, the developer who wants her commute back as time with her kids. It's you, it's me. And together, through 1,000 tiny choices to stay or to move, we make the whole thing tick. If this video gave you clarity, do me a favor. Click the like button, subscribe to the channel, and turn on notifications so you don't miss future videos where we break down money and the economy in plain English.